Welcome back to the Deep Dive. Today we're tearing into the Qualys third quarter 2025 earnings call.
Yeah, this is a big one.
Absolutely. Now, if you follow this space, you know Qualys, always profitable, solid company, but maybe a bit, overlooked sometimes in the big cyber growth story.
Definitely felt that way. But this quarter, it felt like a real turning point. The market reaction was immediate and pretty dramatic.
Right. A massive repricing event, like you said before we started. It looked like strategic execution finally paying off in a way that really resonated.
Exactly. Plain and simple. The stock jumped because this wasn't just a beat. It was a beat with a story, a convincing forward-looking narrative about profitable growth and where their product is heading.
Okay, so our mission today, unpack those financials, yeah, but maybe more importantly, really dig into this ambitious platform shift they talked about, towards cyber risk operations and this whole agentic AI thing.
Definitely need to get into that.
So let's start with the numbers, the foundation. What was the top line snapshot that kind of kicked off this positive reaction?
Okay, so the financials were, frankly, exceptional. They really showed off that operational leverage they have. Non-GAAP EPS, $1.86. The consensus was looking for $1.56.
Wow, so $1.30 beat. That's significant.
Huge. And that's a 19% year-over-year growth on the bottom line. Revenue also came in strong, $169.9 million against expectations of $166.3 million. So about 10% growth there.
Nice beat on both. And those are solid growth numbers, yeah. But like you said, the profitability, the leverage, that's where it gets really eye-popping with Qualys, doesn't it?
It really does. They run such a clean, efficient operation. Adjusted EBITDA was $82.6 million. That works out to a 49% margin. Almost half.
Incredible.
Up 19% year over year, too. But honestly, for you, the learner, the number that really signals just how healthy they are, it's the cash flow.
Okay.
Operating cash flow OCF hit $90.4 million. That's a 53% margin on revenue. And it grew 48% year over year.
53% cash flow margin, that's just huge.
It is.
Yeah.
And that kind of cash generation, that's what lets them fund these big R&D pushes like this whole platform shift organically without needing outside cash or sacrificing profit.
Right. Makes sense. And the forward-looking indicator, calculated current billings, CCB.
Also strong. $186.4 million. That's an 11% increase year over year. So yeah, the money's coming in, the profitability's top tier.
Okay, so the foundation is solid. Let's talk about where they're putting that money and why this call felt so different. It really seemed to hinge on this big strategic pivot, right? The platform change.
Exactly. This was the core message management was hammering home. They're moving beyond just vulnerability management detection and response, the VMDR platform, to something they call comprehensive risk surface management.
Okay.
And they're doing that through the new Enterprise TruRisk Management platform, or ETM. The key idea is that just knowing your attack surface, all your potential vulnerabilities, isn't enough anymore. It's overwhelming.
It's the classic security problem, right? Alert fatigue. A million warnings, but which ones actually matter? Which ones can really hurt you?
Yeah, precisely. So ETM is designed to answer that question. It's about understanding your risk surface, the vulnerabilities that are actually exploitable, that are relevant to your critical assets, and quantifying that risk in business terms.
And this ties into the Risk Operations Center, the ROC concept they mentioned.
It does. The ROC isn't just another dashboard. It's more like a framework, a way of working, designed to centralize how you prioritize and respond to threats before they cause damage. It aims to operationalize risk management.
Making it practical, not just theoretical.
Yes. And crucially, putting it in terms that, the CFO and the board understand. Dollars and cents risk, not just CVE scores.
That's the holy grail, isn't it? Bridging that gap between security tech and business impact. So did they give any proof points, any signs that this ETM platform is actually catching on early?
They did give some concrete signals, yeah. Management specifically called out that over 28 proof of concepts, POCs, have already converted into paying ETM customers.
Okay, 28 conversions already. That's not bad for a new platform.
It's a strong early sign. And they actually drew a direct comparison to how VMDR adoption started years ago, which obviously turned out to be a huge success for them. So they're feeling confident about the trajectory.
All right, let's dig into the tech powering this. The AI component seems central. They launched a marketplace of agentic AI-powered agents within ETM. Now, agentic AI, it's a buzzword, sure, but what does it actually do for the customer here?
Yeah, it's important to unpack that. It sounds like a potential huge differentiator. So lots of security tools use AI for, say, better detection or correlating alerts. Agentic AI goes a step further.
How so?
It means these AI components are designed to be more autonomous. They can perform multi-step workflows and make decisions on their own based on the data.
No.
So instead of just flagging, here's a critical risk, an agentic AI might automatically correlate it with threat intel.
Okay.
Then maybe use something like TruConfirm, which we'll get to validate if it's actually exploitable in that specific environment.
Right.
Assign a business risk score based on the asset's importance, and maybe even initiate a native remediation action, like deploying a patch. All potentially without a human needing to step in for every single stage.
So it's moving from AI as an analyst assistant to AI as an automated workflow engine, almost like a digital employee for specific tasks.
That's a good way to put it. It's about automating entire risk workflows, not just isolated tasks.
Yeah.
The goal is to drastically cut down on the manual effort, the toil for security teams.
Makes sense. And you mentioned TruConfirm. That sounded like another key piece they highlighted.
Definitely. They position this as a pioneering capability, something that really sets them apart from just scanning for vulnerabilities.
How does TruConfirm work? I mean, isn't confirming vulnerabilities what penetration testing or BAS tools do? What's different here?
It's about doing it safely, automatically, and at scale within the risk management platform. Most vulnerability scanners rely on signatures, version numbers, configuration checks. They tell you might be vulnerable. TruConfirm aims to go further by running safe, non-destructive exploit checks to validate if that specific vulnerability is actually exploitable in your environment right now. It's like checking if the key actually turns the lock, but without opening the door.
Gotcha. So it confirms the exploitability, not just the presence of the vulnerability.
Exactly. It validates the potential attack path, proving the risk is real and immediate. It helps cut through the noise and lets customers focus on the 5 fires that could actually burn the house down, not the 500 potential sparks. And importantly, it's baked into the ETM platform.
Okay, so if ETM combines this risk quantification, the agentic AI automation, and TruConfirm validation, it sounds powerful, but it needs to translate to dollars. Did they talk about monetization? What's the expected financial impact?
They were surprisingly direct and very ambitious on this point. Management stated ETM is expected to drive an uplift of up to 100% over a standard VMDR deal.
Wow, double the revenue per customer, potentially.
Yeah. Potentially, yes. That's the target ceiling. And the logic is that ETM effectively bundles in their higher value capabilities. Things like their cybersecurity asset management, CSAM, catch management, plus it ingests third-party data to give that unified business risk view. It makes the whole platform much stickier and justifies a higher price point.
A 100% uplift potential is huge. And to underline how serious they are about this ETM shift, they're changing their reporting metrics, right?
That's right. Starting with the Q1 2026 call, so early next year, they plan to stop reporting the LTM bookings specifically for CSAM.
Okay.
And instead, they'll focus reporting on the ETM customer penetration rate. How many customers are adopting the full platform?
That's a massive signal to investors, basically saying, stop counting the pieces, count the platform adoption. This is the future growth engine.
Precisely. They want to be judged on ETM success. It's clearly the core pillar going forward.
Okay, let's shift gears slightly. Beyond the core platform, what other market factors or leverage points helped them this quarter? The federal space seemed like a big win.
Oh, absolutely huge. Achieving FedRAMP High Authorization for their GovCloud offering. That is a really big deal.
Explain that a bit. Why is FedRAMP High so significant?
Think of it like getting the highest level of security clearance for a cloud service provider to handle sensitive government data. It's a very rigorous, time-consuming, and expensive process. It requires demonstrating exceptional security controls and processes. Getting high authorization opens up opportunities with agencies handling the most sensitive types of information.
So unlocks a much bigger chunk of the U.S. federal market for them?
Exactly. A market segment with potentially large, long-term contracts. And they already saw a payoff.
They mentioned a specific deal.
Yeah, they highlighted a high 6-figure upsell with an existing large government agency. This agency consolidated something like 17 different Qualys modules onto the platform, partly because of that FedRAMP High status. It's a clear proof point that the investment is translating into real business.
Okay, that's a strong catalyst. What about outside the U.S. and how they're selling? Any interesting trends there?
Yeah, a couple of points stood out. International revenue growth was actually faster than domestic, 15% internationally versus 7% here in the U.S. So good geographic diversification happening.
Healthy sign.
And their channel strategy seems to be really firing on all cylinders. Partners now account for exactly 50% of their total revenue. That's up from 47% a year ago.
half their business through partners now.
Right. And importantly, the revenue growth from the channel, which was 17%, significantly outpaced their direct revenue growth, which was 5%. So that partner-led motion is scaling really effectively for them.
Makes sense for expanding reach efficiently. They also talked about a new pricing model, QLEX. How did that land?
Yeah, QLEX. It's their new flexible platform pricing program. The idea is to make it simpler for customers already on the platform to add new modules and capabilities as their needs grow without complex renegotiations every time.
Reducing friction for upsell.
Exactly. And they said the early feedback, even from the beta phase, was very positive. They pointed to one specific example, a Global 10 customer. So a huge company that increased their annual bookings with Qualys by over 50% under this QLEX program, just by adding more modules easily.
Okay, so QLEX could be another lever for expansion within existing accounts.
That's the idea.
Now, we should probably address the one metric that didn't quite pop like the others, the net expansion rate, NER. It stayed flat quarter over quarter at 104%. For a platform company, you ideally want to see that number climbing, right?
Yeah, that's fair. 104% is decent. It means existing customers are spending slightly more on average, but it's not showing strong acceleration yet. Management definitely acknowledged this.
What was their take on it? How do they plan to boost that NER?
Their answer was basically ETM. They see the adoption of the full Enterprise TruRisk Management platform with all its bundled capabilities and the natural upsell opportunities for things like their TruRisk Eliminate remediation features as the key mechanism to drive that NER significantly higher over the next few quarters.
So ETM success is directly tied to improving that expansion rate. Investors will be watching that closely.
Absolutely. That NER figure will be a critical validation point for the whole ETM strategy going forward.
Okay, let's bring it back to the investor perspective then. The guidance they issued that really seemed to seal the deal for the market's positive reaction, right? They didn't just nudge it up, they significantly raised their outlook.
They really did, and I think the strong Q3 performance gave them the credibility to do it convincingly. For the full year 2025, they raised revenue guidance to $665.8 to $667.8 million.
Okay, nice lift there.
But the real jaw-dropper was the non-GAAP EPS guidance. They boosted that range all the way up to $6.93 to $7 per share.
Wow, compared to what previously?
The prior range was $6.20 to $6.50, so a nearly 50-cent raise at the midpoint on full-year earnings per share. That's huge.
That massive EPS jump really speaks to that operating leverage and profitability we talked about earlier. They expect strong flow-through.
Definitely. But interestingly, on the flip side, the full-year outlook for calculated current billings growth was guided to finish around 8%.
Okay, so 8% CCB growth, but revenue growth guidance implies something closer to, what, 9, 10% for the year? Why the difference? Does that signal a potential slowdown in new business momentum next year?
Management addressed that. They attributed the slightly lower full-year CCB growth forecast primarily to really tough comparisons they face in Q4 of last year. Q4 2024 had unusually strong billings.
Oh, okay, a comps issue.
Yeah, that was the explanation. And if you connect it back to their strategy, they aren't necessarily trying to win purely on volume, like detecting the absolute most CVEs. Their pitch is different.
Right. It's about the prioritization, the actual risk quantification, the native remediation capabilities within ETM, a higher value sale.
Exactly. And that ties into how they manage R&D too. Did you catch the part about internal efficiencies?
I did see that. They're funding all this ETM and AI development without letting R&D costs explode. How are they managing that?
That was interesting. They said they're using AI tools internally, tools they've built for their own engineers. And they claim these tools are delivering significant efficiency gains somewhere in the range of 20 to 25% productivity boost for their engineers.
Wow. So AI is helping them build the next platform faster and more cheaply?
That's the idea. It creates this sort of efficiency loop, letting them innovate rapidly on things like ETM without a proportional jump in R&D spending, which obviously helps maintain those impressive margins. It's a subtle but important competitive advantage.
Very smart. And one last point before the trade idea, shareholder returns. Still active there.
Yep, consistent message. They bought back $49.4 million worth of shares in Q3 alone.
Okay.
Shows confidence in their own stock, obviously. And they still have about $205 million left on their current share repurchase authorization.
Got it. Okay, let's do it. Time for our This Is Not Financial Advice segment. So, setup. Qualys stock rips higher, maybe 20% plus after this call. The market seems to be buying into the ETM, AI, and FedRAMP story in a big way.
Right, but before this, as you noted, it was lagging the broader cybersecurity ETF, CIBR, pretty significantly. The market was maybe treating it like, well, a reliable but slightly boring cash cow, not a growth story.
Okay, so the re-rating happened. The thesis now is that this pivot isn't just talk, right? It puts them in a different category, this emerging risk operation space, focused on business outcomes.
That's the core idea, moving beyond just vulnerability management into quantifying and managing business risk.
So we're essentially betting on their ability to execute on this ETM vision. What's the outrageous but plausible trade based on that?
Okay, how about this? A relative value play. Go long Qualys, QLYS, and short the broader cybersecurity ETF, CIBR.
Long Qualys, short the basket. Interesting. What's the specific thesis driving that?
It hinges almost entirely on ETM execution and that monetization potential we discussed. If they can actually drive that up to 100% uplift over VMDR for ETM customers.
Which is a big if, but that's the potential.
Right. And if QLEX smooths the path for those upsells, then Qualys's model, remember, largely organic R&D, integrated platform, high margins, could be positioned to significantly accelerate its net expansion rate and overall growth into 2026.
So the bet is that Qualys, because of this focused organic platform strategy, starts to grow faster than the broader cyber market average, especially compared to some peers who've grown more through multiple acquisitions, which sometimes leads to, less integrated platform.
Exactly. You're betting that their clean, profitable, integrated platform, now aimed squarely at quantifiable business risk, will accelerate and justify significant multiple expansion relative to the rest of the sector. They're trying to define and lead a new, potentially higher margin category within security.
High conviction, you said, but contingent on that ETM adoption really driving the NER higher next year. That's the proof point.
That's the key metric to watch, absolutely.
All right, that wraps up our deep dive into the Qualys Q3 call.
Wow.
Seems like the two really big drivers for that market reaction were, one, just continued stellar financial execution and profitability.
Demonstrated by that cash flow, the margins, the big guidance raise. Hard to argue with those numbers.
And two, this compelling strategic narrative shift towards agentic AI, true confirm, and the whole risk operations center concept wrapped up in the ETM platform. Management sold a vision of durable, differentiated growth.
Yeah, they painted a clear picture of where they're headed, which leads to maybe a final thought for you, the listener, to mull over.
Go for it.
Qualys is making a very explicit bet here. They're shifting the conversation from technical vulnerability scores, CVSS numbers, number of CVEs, towards quantifying cyber risk in business terms. Metrics that resonate with the CFO, with the board.
Right. Aligning security spend with business impact.
So the question to consider is, do you think that focus, the translation into business risk, is the single biggest differentiator that could finally let Qualys break away from the pack and the volatility we sometimes see in the traditional VM market? Is quantifying risk in business terms the ultimate moat for them?
That is definitely the defining question for Qualys moving forward. Something to think about. We'll see you on the next deep dive.